Today on Money Unleashed, we will be discussing a stock's beta. A stock beta is a statistical measurement that compares the volatility of returns on a specific stock to those of the market as a whole. It is an important indicator of the risks and opportunities of an individual stock. Stocks all have an inherent volatility that describes the up and down movements in the stock's historical returns. Volatility is used to evaluate a stock's returns versus potential risks. It can change over time for each stock and will vary somewhat depending on which historical period it is calculated from. One of the main elements of a stock's volatility is the nature of its business. As certain businesses are simply more stable over a period of time, while others have greater ups and downs and movements in their returns. The overall market has volatility also, which we also measure by using the volatility of the S&P 500 index. Beta is essentially the comparison of the volatility of a particular stock to that of the market as a whole. We can think of this as the ratio of a stock's movements relative to the market, as shown in this table. Now, a beta of 1, the stock tends to move up and down just as much as the overall market. A beta greater than 1, the stock tends to move up and down by a greater percentage than that of the market. And lastly, a beta less than 1, the stock tends to move up and down by less than the market. Thanks for joining us here at Money Unleashed as we go through educational topics and all of the great things going on here at Hoffman Financial Group.